Hey everybody, welcome back. And this is the second part of the case study, talking about a real property, one that actually closed. And the first part was, how did we make the decision about the schools, the location within the neighborhood? But the metrics, obviously, if you're investing in real estate, are extremely important. And so I want to go through that with you in this program that I use. I've been trained on it for years and years, and it's really good. And so let's start. This property was, it's called the Enclave at Redstone Ranch. So if I was doing this for you, I would be putting in possibly the address or something of this nature. The property was purchased at $299,900. The acquisition costs were about $6,000. We did an interest rate buy down. And so the closing costs were about there. Loan to value is 80%. So in other words, we did the minimum with no mortgage insurance on Fannie Mae. The interest rate with the buy down was 5.75%. So we put that in there, and it was a 30-year fixed rate. Now, on a property data, this particular property actually rented at $1,900. In this area, and this is, you're always gonna have a little bit of vacancy. There's never gonna be like a person moving in, moving out one day, and then moving in the next day. So we have very low vacancy in this area. So the vacancy allowance is 3%. Now the taxes, let me get that right. This was the starting taxes on it, and was $3,420. Our taxes are pretty reasonable where I am. Insurance-wise, it was $1,100 a year. Now that seems low, I'm sure, to some of you. A couple of things. First of all, every state's going to be a little bit different. We talked about, right now, Florida is at this moment, it's a terrible state to get insurance in. It's 3 times the national average, but it's based wherever you are on simply the amount of claims that are coming in, what they have to pay out. They are profit-making organizations. So that's the case here. And also you get a discount, normally about 30% when you buy new construction. So that's one of the advantages of buying new construction. Now we have no utilities. Mainly because with single-family homes that we're talking about, the utilities are paid for by the tenant, so there's no expense to you. Now, the next thing that we go into is the repair and maintenance. So I'm going to put $1,000 a month. Now, remember, in new construction, you have warranties, some of them typically as much as 5 years, and so you're not going to have a lot of maintenance, although there will be, aches and pains that a house has, some touch-up on the paint, whatever it happens to be. Maybe if it has carpet, the carpets need to be cleaned. In this case, it was all tile, except in the bedrooms. When you use all tile and you use high-grade vinyl plank, and we're doing a lot of that in new construction, you really cut down on maintenance a lot. Carpet is going to be one of your biggest items in that respect for change. In this case, the management fee was 8%. There is no advertising whatsoever. This is not something you pay. And then there's a homeowners association. In this case, it was $240 per year. Most of the homeowners associations in where I am are going to be that way. You get into a gated community or something that does lawn maintenance, then it's going to be a whole lot more. In this case, what they do, maintain the common areas, they maintain fencing, they maintain the landscaping. That's a common area landscaping like in the entries. So that's basically what that is. So what we want to do is we want to do a full analysis because we want to get everything that we need to know. Now, in this case, one of the good things about this is the actual value was $330,000. It appraised for that much more. When we did it out of the dirt phase, so in other words, nothing had started when they put it under contract, but by the time it was done, it was $330,000. It's actually more now. It's been a year and a half. It's more like $350,000, $360,000. Mainly because this person really bought this really, really right. And remember, it was in a neighborhood that didn't have any rentals. And so that was a really cool thing. A lot of more expensive owner-occupant properties. Now, the improvement at allocation is 80%. So in other words, we put 20% down for the lot. And remember, when we do a depreciation schedule, it's on the improvements only. Land never depreciates. So, you can go to your courthouse records, and normally courthouse records will divide this out. So you can see, is it 10%, 20%, 30%, whatever it happens to be. If you're in California, obviously you know that your lots are going to be very, very expensive and probably a higher percentage. So it varies, again, depending on where you're buying. Improvements at purchase, this was a turnkey. So in other words, that fence blinds, garage door opener, landscaping, appliances, everything. There was nothing that the investor had to put into it. Existing homes, it may be a situation where you have to have some kind of allowance on that. Now, in this case, I used a 7% holding period. That's a standard. I can change that and make it 10 years, make it whatever you want. Appreciation, we used 5%, even though it's been greater than that. Remember that we're projecting out 7 years, 10 years. And so even though appreciation may be higher, it's better off that we go lower and say this is a minimum expectation, because we don't know what's going to happen in 5 years. We really don't know. Now, I can tell you that this area has a 20, 30-year history. That's fantastic. You know, it's a conservative way to going about things, but again, don't use the highest possible appreciation. Either use the lowest or the most likely scenario. Now, the projected cost of sale, we have to put this in here in order to determine what your net proceeds are going to be. And tax bracket, I'm going to use 35%. A lot of people I deal with are in that particular tax bracket. Actually, in this case, the actual state tax bracket that you're going to be charged on. Now, remember, you're not going to be charged taxes if you do this right, but we have to put the state tax in there. Right now, I'm using about 2.5%. Now, the reason why I'm using 2.5 is go with the times at that time, although there's now 4.5% where you can put your money in. So in other words, any monies that come from the property, we're saying we're putting it into savings, we're not touching it, but we're putting into something that earns interest. So then we hit the magic button, which auto-calculates everything, and here we are. Now, the first thing that you'll notice is something that's a little strange, where you've got negative cash flow, and that's real negative cash flow. You're going to be putting out $2,215 a year based on this scenario. Now, interest rates have a lot to do with that, okay? So in other words, if our interest rate was 4.5, this wouldn't be the case. We'd have very solid positive cash flow, and we're expecting that by 2025, but that's not where we are right now. Now, the interesting thing is your annual cash flow after taxes is $671. How could that be after tax and be positive? It's very simple. This is a calculation based on the depreciation schedule, based on any losses that you have. That $2,215, that's a loss to the IRS. It's a loss that carries forward. It lowers your tax basis upon sale if you sell it outright. So, initial investment here with down payment at closing cost and everything, $65,980, which you're going to get back. So, projected cost of sale in 7 years with a 5% appreciation, $464,000, $343,000. What that means is you get all your money back, everything plus $188,532 in terms of profit. Now, that's pretty fantastic for a very conservative investment, and it's going to show as we go down below. So let's look at some of those parameters that we talked about in a previous module. First of all, it's cash on cash. How much of your money are you getting back? In this case, it's a negative number. It's negative 3.36%. Some of the investors I have are going to say, that's no big deal. I don't mind. I mean, if you make $300,000 a year, $400,000 a year, okay, I'll accept the loss for the end game. Now, I do have properties, and you're going to find properties in other areas, probably lower in price than $300,000, and I do have some of those with positive cash flow I could have done. I wanted to show negative cash flow so you can see that even if you don't have positive cash flow, you can make money on an investment if the appreciation is right, if the property is right, and it stays rented. So, the equity build, this is how much equity that we estimate. So 5% is what we put in there, but that's not the actual equity. There's got those expenses in there, don't we? We have maintenance involved. So it's actually 4.68%, all things said and done. So not that much different, even though you're putting out about $7,000 in maintenance costs. Capitalization rate is 4.86%. Now, when rates were really low, we were getting 7.5. That's just no big deal. Although, again, ultimately, the number we want to see that's really important, and by the way, this doesn't disturb investors at all. I just want you to know. that, it's something that it's not where they're really looking. That cash on cash, they're looking at very seriously. But look at the bottom, the after tax and the before tax rate. Now, let's look at the before tax rate first because it's 24.24%. What that means is it's based on this scenario, based on the appreciation, based on the numbers that you're getting. It means that on our money, we're making over 24% per year. And that's a good thing to look at because what are you getting from a stock? What are you getting from an annuity? What are you getting from a mutual fund? What are you getting from a savings account? Remember, we talked about inflation running at 9% at one time a year ago. And therefore, what we're doing is we're beating by a big number the rate of inflation. Now, in a later module, we're going to talk about the 1031 tax deferred exchange, where you don't pay any taxes at all. And that's where 24% will be your real return as you put it into more property when we get to that. After tax is because you pay two taxes. First of all, we have what's called a basis, which your CPA will let you know. This is based on things like, how much, you had to put into the property, if you had to put in extra money, any repairs, any improvements, they're going to create what they call a basis. And on that basis, the first thing that we do is we compute that 25% of the depreciation schedule has to come back. In other words, you have to pay that in taxes. Then that lowers your basis. And then the next thing that happens is capital gains. And we know that can vary. But this is a normal capital gains return. So even if you sell this outright and pay taxes, you're still over 16%. So if you just want to cash out, it's still fantastic. It's still just about better than almost anything that you can do. And again, you can speculate on stuff. For those people a year ago that bought Meta at $80 and now it's $300, well, that's great. But something? It didn't have to do that. That's taking a bet. And it turned out to be a good bet, but I've done some things that haven't been so good. So this is a conservative investment. This is a situation where you can get 16 to 24% returns. The most important thing is that this is done for you. In other words, if you want to really know what you're putting your money into, and it's not a guessing game, and I don't like to guess, I really don't. I want something a little bit harder in my numbers. This is what you have to do. And it has to be based on realistic numbers. And again, if you bought a house that was 30 years old, I wouldn't use $1,000 on my maintenance. I'd use $3,000, meaning because I know that certain things are going to break down because they're getting old. And so, we're going to vary that according to the type of property that you're buying. So these numbers are nice because this shows you some advantages of new construction. Now, a disadvantage might be that if you bought a 5 or 10-year-old version of this house, you have a little higher maintenance, but maybe the price instead of $300, maybe it's $260, who knows? So in other words, I'm not telling you that the only thing you ought to do is buying new construction, although it has its advantages. But if you're buying an existing construction, remember these numbers. If we want to get this kind of return, it's got to be probably a lower price and some really solid rents, because some of these other numbers, like the maintenance, is going to be higher. And by the way, remember we talked about insurance on the first page, about a 30% discount. Understand that insurance on a 5-10-year-old property, even if you buy it new, it becomes 5 years old, your insurance cost is going to go up. So remember, the specialist is going to put those numbers in there for you so that you get an actual return on your investment based on real dollars. So we're not going to use $1,100 if you bought this 5 or 10 years old. But every time you buy something, this is what has to be done. This is the only way that I know if this is a return that I would buy. Because again, I'm an investor and I don't want you to do what I wouldn't do. So the numbers have got to work. Metrics are the most important thing. Make sure they can compute this. Make sure you get this type of a spreadsheet. So thank you for listening. More to come. Hang in there. Thanks for being here.